Good morning, everybody. I'm Carrie Slavens, and I'm here with South Island Prosperity Partnership. We're very pleased to welcome you this morning to Canada's Leading Economists. This is a series, and this is the first in our series of member events that we wanted to host to ensure that you, our members, have access to the latest information from Canada's leading economic thinkers. Today, South Island Prosperity CEO Emily de Rosenroll will be talking with Eric Lascelles, Chief Economist of RBC Global Asset Management. I know we're in for a fascinating presentation from Eric. So with that, I'd like to turn it over to Emily, who is CEO of SIPP and Chair of the Rising Economy Task Force. Over to you, Emily.
Great. Thank you so much, Carrie. Well, 2020 was a year like no other. Global shutdowns plunged national economies into the worst recession in nearly a century, sending shockwaves through our society, political, economic, and social spheres. Many economists claim that 2020 was actually the year that simply never was. So here to give his insights to these questions and more, today it's my great pleasure to introduce someone at the forefront of Canadian economic thinking. This is Eric Lascelles, the Chief Economist for RBC Global Asset Management, Canada's largest asset manager. He maintains the firm's global economic forecast and advises its portfolio managers on key themes and risks. He is also a member of RBC's Investment Strategy Committee, which is responsible for the firm's global asset mix recommendations. Eric is a frequent commentator on economic and financial trends on CNBC, BNN, and other networks. His editorials have appeared in the Globe and Mail, the National Post, the Wall Street Journal, and the Financial Times. We're very grateful here today to have Eric with us, exclusively for SIPP members and their guests, to give us some insights into the economy in the months ahead. We'll be co-hosting a Q&A session after Eric's presentation, so please put all your questions in the Q&A, and Eric will have an opportunity to answer as many as he can. And now over to you, Eric, who's going to tell us if there's going to be an end to the end of the economy as we know it. Thank you, Eric.
Right. Thank you so much, Emily. It's a real pleasure to be here. Thank you, Carrie, as well, the technical crew. I didn't know I was the inaugural speaker. My goodness, that's quite an honor. So thank you very much for having me. And of course, there's so much to share. You've already nicely encapsulated 2020, which was a pretty remarkable year. But I'm going to focus on 2021 and where we're going from here. And I won't profess to have a crystal ball. I get things wrong regularly, but I'll hopefully give you some perspective on the situation, and happy to tidy things up via the questions at the end. Believe it or not, I have a minor in computer science. You may not believe that, as I now struggle to share my screen, but let's see if I can actually make this work and perhaps vindicate my computer science professors. I'm going to presume you're all seeing that unless someone starts screaming. And so you can see the title of the presentation I have. It's mostly optimistic about 2021. And so I should certainly acknowledge, as we'll get to in a moment, there are new variants and the infection numbers seem to be rising. And so not exactly the environment in which one would normally feel great. But I will say we still pretty profoundly believe this is a year of important economic recovery. We think the world is going to look pretty close to normal by the end of this year, if not quite completely. And indeed, it's the year of the vaccine, as much as we've all been a little grumpy in Canada at the rate of that rollout. And so more optimistic than not. And in economic language, I would say we have above consensus growth forecasts. And so we look for a recovery. So does the market. But we think the recovery might be a little bit zippier than the market currently assumes. Okay. Here's my next challenge. Wonderful. So let's just run through sort of a report card or table of contents of sorts, and then we'll cover off many of these things in more detail over the proper presentation. And so, as per the optimism beats pessimism story right now, we see a lot of good things happening at the global level. And so COVID cases have plummeted quite impressively relative to the start of this year. Accordingly, hospitalizations and fatalities are down sharply as well, indeed to a greater extent because of the vaccinations targeting the most vulnerable. Vaccinations, of course, are accelerating from here. Again, Canadians a bit grumpy, but nevertheless making significant progress and really will accelerate further in April, May, June. Real world vaccine efficacy seems to be high, not perfect, but quite high for the most popular vaccines. And even the ones that seem a little bit less effective, they do almost eradicate the rate of hospitalization and death, if not infection. We were most recently tracking economic damage from the second wave, that wave that began early last fall and ran through really until quite recently. And ultimately, the economic damage was quite small. It was nothing like the first wave. In fact, it was even less than we'd assumed, and we'd assumed it would be pretty small. Economies are now mostly recovering. We're seeing economic growth more often than not. The US has just done actually 2 rounds of massive fiscal stimulus over the past few months. I think it might be a bit too big if I'm being honest, but nevertheless, certainly will help to drive the US and global economy forward, with some implications for Canada as well. And as I mentioned, we do have above consensus growth forecasts. So lots of good things. In terms of the negatives, COVID cases edging higher again. So we are budgeting for a third wave that I'll get into a little bit later. Variants are really the driver, we think, of that third wave. Vaccines are less effective against some variants. So there are some channels here by which we could have more enduring trouble, but we're not convinced it has to go that way. As mentioned, Canada's very much lagging, at least in a vaccination sense, though it's done very well in terms of infections per capita, and its economy has certainly done better than Europe or the UK, as an example, if not as well as the US. Herd immunity, we think, may be elusive for the moment. We're not convinced we get to the point where the virus just goes away. At a minimum, you'd need to get children inoculated, which seems likely, but probably not until the fall. And ultimately, there are a few other complications that mean this may stick around in a milder form beyond 2021. Rising inflation fear is certainly a new issue, and one that I've been thinking a lot about and being asked a lot of questions about. And so we'll talk more detail about that. I think there's some validity to it. Inflation is rising. In fact, it's going to be quite high in the next few months, but we think it tames its way back down, and we don't believe there's a structural problem brewing that suggests we're into a new inflation regime. And then just in the interesting category, things that don't quite fit into either of those two buckets, I can say we're not expecting enormous lasting consequences from the pandemic. We think most things go back to normal when the pandemic is done, with some exceptions. We'll talk about that. And then rising bond yields. Of course, we've seen a sharp increase in interest rates. Anyone out there looking to buy a home recently will have perhaps taken note of that. This is not entirely unexpected. It's a function of stronger growth and higher inflation and vaccination optimism and all of these things that fit together fairly logically. We do think it's actually gone a bit further than it should, though. Our view is that yields are slightly higher than they can sustainably be just in this imperfect environment with still high unemployment rates. So some backtracking there, but certainly not all the way back to last summer levels. Okay, that was the boring part. Let's now put pictures to those words. And just to begin with, as I'm sure you're very well aware, get my mouse out of the way here. We can say certainly Canada has been through quite a real second wave, as you can see, beginning to rise in. It was August. I remember being very concerned in August and wondering why policymakers weren't doing anything, and it took them, in fact, many months to do much. But really in September, then starting to rise significantly and ultimately spiking just after Christmas, in part because of Christmas. We think socializing at that time was part of that final spike, but ultimately a happy declining trend from there. But you'll see over March, we've ceased to improve. We are starting to deteriorate. And so that is a concern. And it's why we're talking about third waves. We don't think a third wave needs to have as high fatalities or hospitalizations as prior waves. That's the beauty of these vaccinations that are targeting the most vulnerable fairly well. But you can see, for instance, the real driver is virus variants. It's these more contagious variants. It's mostly the UK form for Canada, but also the South African, the Brazilian. There's a New York City one. There are quite a few brewing right now. And the numbers are very murky. So this in front of you shows an estimate of the rate at which the variants are growing week over week. And so I don't actually believe the US growth rate is 4 times higher than Canada. The prior week, the numbers were about the same. Canada was 70%, US was 80%. The US numbers actually are still at the aggregate going down in terms of their overall number of infections. And so I think that the data is still very blurry, and we're not seeing a lot of testing, and the protocols differ depending on the country. To me, the main message here is that in both countries, we are seeing significant growth. Whether it's 23% or 83%, that's fairly rapid expansion of the variant numbers. And it suggests essentially that although existing social distancing restrictions are sufficient to control the traditional form of the virus, they are not sufficient to control these variants. And so there is a risk that we have to see additional lockdowns happen over the next month or two in response to this. We'll see if policymakers actually do that. There certainly is a reluctance to lock down again, understandably. Similarly, there's some hope perhaps as weather gets warmer, this all goes away by itself. There's realistic hope. In fact, I'm stealing my thunder here. There's realistic hope that as vaccinations continue, it becomes harder for variants to spread. And I think that's all fair. I guess what I would say is this: there are a lot of different relevant considerations at play here. If you look at that row at the bottom, overall, as we assess it, we think it makes sense that we've been through 2 waves, and we think it makes sense that there should be another maybe mini wave over the next month or 2. And the very first wave, way back when, of course, nobody was social distancing, schools were open, the immune population was practically zero. It was a recipe for spread. Then in the spring and I guess summer and fall of last year, we can say that we saw sufficient social distancing rules and these sorts of things take part. And also the summer seems to allow much less spread. Towards the end of 2020, there was another wave, and in part because there had been some reopening and the seasonal factors got worse and more contagious variants began to spread and so on. Course corrected in the first quarter of 2021. That's where we are now, and now slipping, we think, logically into the second quarter. And again, it's mostly that governments have reopened. That's the orange box at the top of Q2 2021. Social distancing fatigue is a real thing. Most people are not behaving as cautiously as they were 6 months or a year ago. Seasonal factors, we're not quite sure about. It's not clear if this is a virus that spreads most easily in the winter or the spring and the fall. Do note that, for instance, the first 2 waves were the spring of 2020 and the fall of 2020, less so the winter. So it could be the spring is a tricky time again. Conversely, of course, the flu and other things are usually a winter variable. So we don't quite have an answer, but it could be the spring is actually trickier than the winter was in that regard. Of course, we have schools disproportionately open, and most importantly, these more contagious variants. So we do look for a wave. We think, though, it will be snuffed out fairly quickly, but it could nevertheless be consequential in the short term. In terms of the vaccination efforts to stop all of this, and indeed there is a fighting chance that places like the US and UK don't have that wave because they've made such progress, you can see quite a significant variation in the rate of vaccination. So there's Israel very much winning, 111 doses injected into people per 100 people. So they're already on to the second dose per person at this point in time. Keep in mind, 200 doses per 100 people would in theory be everybody getting 2 doses, though at this point children aren't eligible. The Emirates, Bahrain have done well. But in terms of big, rich countries, the UK and US really stand out at 44 and 36 doses per 100. You can see a bunch of European countries all around 12, 13 doses per 100. And there's poor Canada down at just 10. Now, that is significant improvement. I should also say this is a bit of a cherry-picked chart in the sense you can certainly find countries well behind Canada. Japan has barely started. China and India are moving quickly, but their populations are so big that they're well behind Canada. And again, most of the world's poorer countries haven't made much progress at all. But the fact remains, Canada has lagged compared to most of its wealthy, developed world peers. And so that's been a source of frustration. And we've been inclined to attribute it to a mix of ordering the vaccines a bit later, though Canada ordered well before Israel, so that doesn't explain everything. A mix of no domestic production capacity, though Israel has no domestic production capacity. A mix of sort of geopolitical considerations, Canada having less clout, it would seem, than other countries. And so the bottom line is Canada has wound up here, but should accelerate from here because Canada has ordered the most vaccines per capita, in fact. And so they'll all come flooding in over the next 3 to 6 months. And so that should change notably, I think. In terms of how the vaccinations play out, and it's not exactly working this way, I would say there's been more of a focus on age-based eligibility and a little bit less on activity-based eligibility than would be ideal. But nevertheless, round 1 has been quite straightforward. And so older people, vulnerable people, frontline medical workers have broadly been vaccinated. I should say the share of population, Canada didn't get to 15% in the first quarter. Countries like the US got well beyond. This is a bit of a stylistic in the middle kind of set of numbers. And so just recognize that as much as the end goal is herd immunity, is just eradicating this virus, if possible, there are big implications that happen well before that. And so you inoculate that first 10 or 15% of the population, that is almost entirely the group that dies from COVID-19. 80% plus of the deaths are in those groups. And so we should see, and I would argue, are beginning to see a very, very sharp drop in fatalities. And so that's quite a big deal. Round 2 seems like it's mostly just younger, but in theory, younger frontline non-medical workers as well. But that's more of a spring proposition. That's a bigger share, but still a limited share of the population. Doesn't change the fatality numbers that much. It does, but not that much. Big effect on transmissions. That's the group that's transmitting it. It's the people working in close quarters with one another. And then lastly, you've got round 3, and that would be younger people, healthy people, remote workers like me. And so we get it later, and we're a pretty big share of the population, and we're not the group dying from it because we've been pretty well isolated, and we're not the group transmitting it because we've been pretty well isolated. But nevertheless, you want to inoculate everyone if you can to allow a normalization of life. And when I look through that, I would say, when does the economy get to reopen in all of that? And you've got this extra twist of a third wave, and so that's making things a bit messier. But I would say, seems to me that policymakers very much closed down with reluctance last fall, only when hospitalizations were nearing capacity. And so as we emerge from some of this, and as hospital capacity is diminished, or capacity is looking better, I should say usage has diminished somewhat, arguably that's going to be a key driver. And so if we can keep those fatalities and hospitalizations down, it may well be that politicians are willing to hold their nose at a higher level of infections and even reopen somewhat. Bottom line is, we think there's incremental reopening over this year, but it could be somewhat front-loaded. And then in terms of how social distancing rules have played out, and this has been a big driver of our economic forecasts, of course, when certain sectors get closed, that has a big effect. I can start by saying this is a great Bank of Canada data set they've put together, and you can see all the new rules that came on last spring, and you can see they all eased through to September. You can see broadly they tightened then across the fall, and again, many are easing. And so Ontario was the tightest, the most socially distanced, I suppose, and it's recently eased quite considerably, putting it somewhere in the middle. Quebec is now the strictest for what it's worth. The Atlantic Canada region is the loosest, though they've done so well. I suppose that's justifiable. You can see BC in green there. And so BC didn't tighten as much as others, but also hasn't really loosened all that much. And as someone who's not physically on the ground, I'm not sure if your impression is different, but I'll just say blame the Bank of Canada if that seems wrong to you. But the bottom line is there has been some reopening, and the reopening in the short run is an economic driver. There is some concern, maybe it's been a bit too much reopening, though, just in the context of these variants that are working their way along beneath the surface. We look at real-time economic data. This was unavoidable and absolutely crucial last spring when we were trying to figure out, like, what happened to the economy. Did it shrink by 90%? Did it shrink by 10%? Like, what was the effect? And we were not going to get traditional data that told us that for many months. It was completely unacceptable. And so many of us built real-time metrics, and this is what we built. It's for the US, I'm afraid. The US just is richer in economic data, but it very much does proxy what Canada has been doing as well. And so there's that big, sharp economic decline. We've since learned the real decline wasn't as big as the real-time metrics said. You can see a 35% drop. It was actually about 15 for the US. You can see more than half of the economic decline was recovered by the end of June, which is kind of amazing. You can see there was more gradual growth then, still quite robust, but nevertheless, somewhat more gradual growth across the summer. You can see in theory a bit of a retreat in the US late last year as the second wave played out. Didn't actually show up in truly declining output. It showed up in kind of flat output, but nevertheless, a weaker period. Then you can see some strengthening in January, February. That funny US, not very funny to them, I suppose, weather disaster in Texas in February caused a dip, and now quite an enthusiastic rebound as places like Texas and Florida and others completely eliminate all social distancing rules. And so we think we are seeing something of a rebound. The Canadian reopening experience isn't quite that enthusiastic, but beyond that, it's a pretty similar story. We now have the luxury, at least over a medium run perspective, of looking at the traditional economic data as well. And so this chart shows you the extent to which the Canadian economy shrank during the worst of the crisis. And then those dark blue lines say how much of that has been reclaimed. And so you can see, for instance, employment fell around 25% in Canada. Since then, though, employment has recovered 71% of what was lost. It's still certainly below normal, but notably below, above where it was. Retail sales, kind of incredibly, are now running above the pre-pandemic norm. And so it's partially consumer optimism and enthusiasm, but significantly also it reflects government checks going to people, and some people even making more money than they did before the pandemic, and perhaps people not able to go on vacations, and so spending more on retail activity. And I should emphasize, beneath the surface, there's huge variation here. And so you see some, online sales are practically double what they would normally be, and so online retailers doing great. You can see big box stores like grocery stores and these kinds of companies that have been allowed to stay open. They're broadly selling better better than they normally do. And then you have small retailers, which have broadly done quite a lot worse. So it really does vary. And it varies, of course, by specific retail category as well. You can see, of course, food services and drinking places, a big sharp drop, a 65% drop initially. Notable recovery, but far, far from complete. In fact, less than half. And so that has been a real challenge. That and entertainment, you might say, and I suppose travel and tourism, those are the ones that have been hit by far the most. Some recovery, though. And then industrial production has recovered about 3/4 of what it lost. And so we're of the view that about 70% of the economic decline in Canada has been recovered. We're assuming the remaining 30% is recovered this year. I should emphasize, I'll get to all these numbers in a moment, I should emphasize returning to the prior level of output, which I've just mentioned, that's item 4 here. So we think that happens by the end of this year in the US and Canada, might even be the middle of the year for the US. They are really blazing forward with that fiscal stimulus in particular. However, let's recognize returning to the norm of 2 years ago, or a year ago, at that point in time, close to 2 years ago, is different than a normal economy. You'd still have a higher unemployment rate then, as an example. The economy should have grown over those 2 years of time. And so in fact, item 5 is when economies return to their prior trajectory. We think that's probably more a 2023 proposition, though I'm increasingly entertaining the idea that it could even be somewhere toward the end of 2022. To me, though, the big message in all of this is that as much as this has been a truly atrocious experience, enormously difficult for many unemployed people, for many businesses and others as well, done real damage to the fiscal coffers, the outcomes have been consistently better than initially expected. And so initially the question was, how deep would that economic decline be? The answer is US shrank 15%, Canada shrank 18%, the UK shrank 25%. There was some variation, but that kind of range, it was not unreasonable in March of last year to think that the economy would shrink by 50% for a period of time. Send every human being home and tell them to lock the door. It's kind of miraculous that 85% of activity continued. And so surprisingly mild, as much as equally it's the biggest drop in our lifetimes. It's hard to reconcile those two comments, but I think they're both true. And then the duration of the trough was very short, barely over a month. We thought it would be 3-4 months at least before significant reopening happened. In retrospect, maybe they opened too soon as I think about it, but nevertheless, the bounce happened sooner. And then we figured it would take quite some time to get half of the economic decline back, and it snapped back in a matter of 2 or 3 months. And so again, the winning strategy has been an above consensus growth forecast almost from the get-go. And so it's not the only reason we have above consensus growth forecasts for the future, but certainly it does inform our thinking that people have been surprisingly resilient through all of this. And there has been surprisingly little scarring and structural damage. And we continue to see things like bankruptcy rates that are very low and delinquency and default rates. And certainly appreciate there are many, many exceptions to that comment. But at the aggregate, that's what we're finding. There isn't that much scarring going on right now. We think there's room for a lot of snapping back when this is done. Certainly key supports in all of this have been very easy financial conditions. And so just for those not familiar with this idea, down is good. And moreover, I can say that financial conditions really reflect the way that financial markets affect the economy. So low interest rates, narrow credit spreads, strong stock market, that kind of thing creates easy financial conditions, an environment in which an economy can grow quite happily. And in fact, notwithstanding the recent backup in bond yields, and you can see it's pretty mild effect on financial conditions, that little hook higher at the end, this is about the easiest financial conditions we've ever seen. It's a very generous environment for economic growth. We should expect, we think, more economic growth. And so ultimately, we have economic forecasts that emerge from all of this. I've learned over a couple of decades of being an economist that people don't actually care whether your growth forecast is 5.2 or 5.4. It doesn't really have any real world implication. But I'll just say this then, maybe 3 comments. The first would be we are expecting quite fast growth in an absolute sense for 2021. This is the classic rubber ball economics. What goes down bounces back particularly vigorously. And so let's not pretend that 6% growth is normal, but it's attainable when you shrank by a huge amount the year before. Let's acknowledge that and these green and red numbers in the middle, that's how we have evolved our forecast over the last quarter. So for the most part, we've upgraded our economic outlook compared to the assumptions of a quarter ago. And so vaccines have gone quickly and the second wave didn't do that much damage. That's the sort of logic underneath all of this. And then simultaneously, you can see on the far right side, that's us versus the consensus. So we're moderately more optimistic than the consensus. It's a bit of a moving target, particularly for the US. The consensus is surging higher with that $1.9 trillion stimulus package. But we are above for the moment. We have every intention of staying above. And again, the logic behind all of this, part of it's just vaccines are a big deal. Part of it is that the winning strategy has been above consensus forecasts quite reliably. And part is we don't think there's going to be that much scarring. We're not seeing that much evidence of it. We feel like there wasn't that much scarring, less than expected after the global financial crisis previously. This is very much an artificial shock. Governments say don't do things, and so we don't get to do those things. And when those things become possible again, there's reason to think we start doing them fairly quickly. And indeed, there's a lot of pent-up demand as well. We know in the US there's, gosh, it must be nearly $2 trillion of extra household savings that normally wouldn't have accumulated over the last year. In Canada, it's several hundred billion extra. And I wouldn't expect all that to get deployed on day one. And indeed, it'd be nice if people sat on some of that, given the levels of household debt and that kind of thing. But nevertheless, some of that is going to be deployed. There is going to be some catch up going on, we think. And so we're quite content to be in the optimistic camp as it pertains to the economic outlook, even with this third wave complicating things over the next couple of months. What about the British Columbia economy? Well, let me preface this by saying I'm not really a regional economist. I'm mostly a global economist who dabbles in Canada. And so I'm probably stretching my neck out a little further than I should and pretending I can comment knowledgeably on BC. But I will say this, which is we run our own, it's not quite real time, but certainly faster economic estimates than you would get from Stats Canada. They publish literally an annual GDP estimate for province, and you get it a couple months after the year has ended. We run a monthly series. It's only lagged by a couple of months. And so this is it. And so you can see a number of things here. Alberta swings left and right, or up and down, I suppose, given this orientation toward volatile oil prices. But if you look toward the end and you see, of course, that big sharp decline, I guess the first comment would be that it was a pretty universal experience. Almost everybody shut down in a similar way. There wasn't enormously varied differences there. And so that was practically a global story. You can see the rebound, though, has been different. And so at least up until quite recently, I'm noticing Alberta has really jumped here. Alberta has lagged. And so, of course, it had low oil prices on top of everything else. Oil prices now less low, of course. You can see that BC has consistently outperformed. And so the British Columbia economy notably doing better than others. And of course, you've all controlled the virus somewhat better and for a number of reasons have managed to outperform. I should emphasize, I don't quite believe that the BC economy is 3% bigger, or at least was, let's say in January, 3% bigger than it was the year before. There's no way that the British Columbia economy is actually bigger, but I would say qualitatively it's closer to normal than most are. And I think that speaks to some of the labor market data we've seen and so on. So well done, all of you on that front, certainly. And I suppose going from there and pivoting, sadly, the US has such rich data. We spend more time than we'd like to looking at them. I can say a few things here. And so one would just be, from a business cycle perspective, we believe developed world economies are pretty firmly in early cycle, which is kind of an obvious claim. I mean, we've just had a recession. You would expect the first year or two to be early cycle. But when we put a fairly scientific approach to it, that's also what we get, which isn't always the case. So we're happy to have that. It doesn't guarantee that, therefore, there's 8 years of exciting growth in front of us. There's all sorts of twists and turns, and no two cycles are quite the same. But I would say it gives me some confidence when I see early cycle readings. It suggests to me, well, normally this is a good time for financial markets, and normally it is a time of rapid growth, and normally it's a time when you have a bunch of years of additional growth afterwards. It's not quite a guarantee, but it's a welcome observation. And a quarter ago, we were getting start of cycle readings, and a couple quarters before that, we were getting recession ones. So there is some happy evolution happening in the business cycle. This, by the way, one of the inputs into the business cycle. So again, US metric, but very similar in Canada. Private investment as a share of GDP. You tend to see a boom in corporate investments, essentially, in CapEx and things like this when an economy begins to grow. And we've very much seen that. So this seems as though businesses feel confident that there is indeed a real recovery here, and their very actions help to sustain that recovery. Okay, let's talk inflation for a moment. And so I'm certainly aware there are fears of inflation. I see charts like this all the time as an argument that inflation could be a problem. This is the US M2 money supply. It's kind of exploded higher. How come we don't have 25% inflation if there was a 25% increase in the money supply? I would say some of this is because central banks have printed a lot of money. However, a lot of it is because people prefer liquidity during a crisis. So more people are just keeping money in their checking accounts. And so it just shows up in M2. And if it was in a savings account or in a stock market, it wouldn't show up. think it's unfortunately poorly allocated money to my eye, and often people let emotions overcome what was actually quite an opportunity for investing over the last year. But nevertheless, that's a real driver. And then also keep in mind, households have saved trillions of extra dollars. And so some of that shows up in the money supply and in checking and savings accounts. And so not all of this is money printing. Some of it is just behavioral. And actually, it's money that isn't being deployed that's preventing the economy from overheating in a sense. When we look at the amount of money that's been printed, and so the US is always good to look at because a decade ago they printed a lot as well. So we've got 2 points of comparison. Canada's just done it really the one time. You can see all that money printed in dark blue, the big spike in the monetary base. You can see though that banks have essentially increased their reserve holdings, not quite proportionally, but nearly proportionally. And essentially what that means is central banks printed trillions of dollars. Banks did not have trillions of dollars of additional customers who wanted to borrow money. Banks returned the money to the central bank. And so most of this money isn't even in the real world. And history argues that the money supply really doesn't do a good job of predicting inflation. Yes, in a hyperinflation Zimbabwean or Argentinian or Weimar Republic Germany situation, but not actually in this kind of context. And so when we think about inflation, we tend to think about these factors. And we start with the first row and we say, yes, there are new upside pressures. Let's acknowledge that. And indeed, we are assuming, first of all, a bit of a spike in inflation over the next few months. And really that's because oil prices have rebounded and we're going to lose out of the 1 year window, we're going to lose the crash in oil prices from last year. And so it's going to look like inflation is surging when really what's happened is oil prices went from $60 to a low number and they're back to $60. And so it's not really inflation, it's just a mismatch of appearance of low and then high inflation, but it's really fairly muted. Massive money printing, certainly a risk, as much as I don't think it's a guarantee of more inflation. In the US, there's a new mandate for inflation that wants a little more than 2. There can be temptations to erode high debt. There is some supply chain onshoring. Canada's got a carbon tax. It's probably going to add 0.2 to 0.3% to inflation every year that the government keeps on increasing it. And so new upward pressures. We are ultimately expecting inflation to run a little over 2% over the next few years instead of under. And so I think that is reflected in our forecasts. But I'll say this, 4 of those 5 pressures are quite small. You're talking about drivers that could make 2.25% or 2.5% inflation instead of 2, not the kind of thing that makes 5% or 10% inflation. And I would simultaneously say, and jumping right to the bottom, we think there are important deflationary structural forces as well. So I guess the cyclical one is the economic conditions. We have a high unemployment rate. This is not a situation where you normally get normal inflation, let alone high inflation. We're a couple of years away from getting normal inflation from that driver. And actually, the Phillips curve seems to be so flat that we don't even know if we can get normal inflation in a normal economic environment. Central banks didn't pull that off over the last decade. They struggled to get there. We think the demographics are very deflationary. Old populations are associated with less inflation, and that is very much a fate that is befalling Canada, much as it has already struck Japan and increasingly the Eurozone. A few other smaller items, but I would say if you'd asked anybody a year ago, okay, you probably expect normal inflation over the long run, but if there's a risk, which way does that risk go? Almost everybody would have said the risk is long-term inflation is lower than the norm. And so don't forget about those factors. Those are still the ones that will stick around once the glitter of this pandemic has ended. Speaking of pandemic ending, and I should say cognizant that I'm beginning to work my way beyond the assigned formal remarks time, so I'll zip my way through some of this. So what about lasting implications of COVID-19? I actually put together a mini paper and a presentation on this recently, and really this encapsulates it. And so I think to me, the main point, or at least our main view, is that few of the COVID effects are likely to be truly permanent. And of the ones that are permanent, most of them should fade in intensity, at least somewhat. So illogically, let's start on the right side. We think most things are short-lived. So people are going to socialize pretty normally. They're going to have physical contact. Personal travel should completely resume fairly quickly after people have been vaccinated and the pandemic has been significantly quelled. The economic variables, high unemployment, all these sorts of things, we think that snaps back over the next couple of years as well. So not a long-lasting effect. We have every reason to believe the service sector gets to rebound. That's where, of course, food services are, and travel and tourism and entertainment and so on. And so there's no reason to think that people are going to want more TVs and fewer flights permanently in the future. That should revert. Small business as well, there's a structural issue there and network effects and things, but ultimately the small businesses that have been disproportionately downtrodden, to the extent they've survived this experience, should have the capacity to return to roughly normal demand when this is done. We think public transportation revives. So a lot of these things should bounce back fairly quickly, we think. There are other things that will take a few years, but also we think ultimately fully bounce back. And so we believe that cities and downtowns will ultimately prove as popular as they were before. I'll talk about working from home in a moment, but nevertheless, we think that can happen. In fact, I'm not convinced there needs to be a lower long-term return on investments. If you look at historical studies of great pandemics through history, you do find that, but normally it's because like 30% of the population has died, and this is not the situation here. We don't suddenly have too many machines relative to the population. So I would set that aside. Governments don't have to be bigger forever. I mean, in Canada, there's a chance they will choose to be. There are all sorts of aspirations and more generous UI perhaps being a goal, and universal pharmacare and universal daycare. These are sorts of things the government is entertaining, but let the record show none of these things are necessary because of the pandemic's consequences. When the pandemic goes away, government spending at least should revert to a more normal level. We'll see what else they choose to do, but that's not a pandemic consequence. We think inequality, of course, is high in general, but we think it can revert back to where it was beforehand. The bottom, inflation as well, if it's somewhat high for a couple of years, it can snap back, etc. So a lot of these things could last a few years, but ultimately go away. But maybe the subject of greatest interest is that leftmost column. And so when I think about permanent effects of COVID-19, unfortunately, I start by thinking about more public debt. I don't think we're going to see any politician bold or noble enough to seriously pay that down over the coming decades. So I think we're stuck with more debt. Unfortunately, probably a bit more automation to the extent that companies that swap workers for robots, probably not swapping them back when this is done. Other things we think partially reverse. So these are permanent changes. We think there will be permanently more online spending, but not this much. Some goes back to brick and mortar. Commercial real estate, well, certainly has been weak over the last year. We think there's a partial reversal there. And so some people are going to work from home more, and that is an enduring drag, but not to this extent. And so we should see commercial real estate bounce significantly. And keep in mind, there's reason to think shopping malls can mostly bounce back. There's reason to think that warehouses and distribution centers demand will be through the roof to the extent that that reflects the online shopping boom. So ultimately, much of that can be unwound, but not all. Less business travel. Well, I guess the open question is whether I'll be presenting to you in person in a year or something like that. It's most credible forecasts are that that probably doesn't fully come back. Some of these things don't work too badly virtually. And I won't go through all these things. Significant reversal, so still permanent, but a lot of it unwinds. Lower interest rates. So we do think interest rates should be permanently lower than they would have been without a pandemic, but obviously not as low as they were last summer, probably not even quite as low as they are now. The way I think about it is at all times, maybe the 10-year yield is going to be 10 or 20 basis points lower than it would have been if there hadn't been a pandemic. And the reason is just because you got to afford all that extra public debt, and low interest rates is part of the solution. Working from home, I'm sure many of us will work from home more than we once did. But if you look at surveys of executives, they want their workers in the office more than half the time. And so we'll be working from home more than we once did, but nothing like today, as far as I can tell. And, as much as it seems like everything is working well for many people working from home, don't forget a few things, which is like corporate culture erodes over time when you work from home. Collaboration and innovation is more challenging. It is more difficult to interact with clients in particular. And so a lot of the working from home will fade, but some will stay. And again, I'd like to think there'll be more resources for low probability, high impact risks like pandemics, like asteroid strikes, all those sorts of things that people look at you funny when you talk about. But nevertheless, as we've learned, worth putting a bit of money towards. And so I suspect that emphasis will fade over time, but hopefully some will stick. But again, the point being, most things go away, not completely, but pretty notably. Let me skip a chart just to save some time here. So public debt levels, of course, were high before this began. That's what you can see here. And of course, they've gone higher again. I would emphasize, though, that this has not been a doubling of public debt. This has been like a 25% increase or so in public debt. And so very relevant and unfortunate that we will have to live with this subsequently, made partially affordable by lower interest rates, we think. And I guess the main point would be we don't see evidence of sovereign debt crises emerging from this. It's more debt. It's unfortunate, probably going a little too far in the US right now as they do an extra 1.9 trillion after 900 billion the prior go round. But nevertheless, it's manageable if a little trickier than it once was. And then cities and urbanization, I kind of gave you my spiel on this earlier, but I would just say it's tempting to think that rural areas will permanently boom now and that suburbs will be king relative to downtowns, and certainly would acknowledge for a number of years that might be the case. And indeed, maybe there is even a more enduring suburb versus downtown story. But hear me out when I say, urbanization has been one of the most powerful forces driving humanity forward for 10,000 years. Like it would take quite a lot to stop it. We've seen prior pandemics that did not stop it. There were predictions that the Spanish flu would end urbanization, the Great Depression would. People predicted, this sounds hilarious now, people thought the invention of the telephone would end cities because you could just call into work, I guess, and of course it didn't. And then the computer didn't stop cities, and the internet, certainly could have, and maybe that's what we're dealing with now, but nevertheless didn't, at least for several decades. 9/11, nobody wanted to work in a tall building, and then they did. And so urbanization is a pretty powerful force here. Remote working does change the story somewhat, but very few people are likely to be 100% remote, which is what you sort of need to move 5 hours out of a city. Suburbs can outperform downtowns, I think, for some time, but probably not permanently. This has been a classic ebb and flow, pendulum swinging back and forth story for a very long time. And it's worth just reflecting on, like, why do cities exist? What's the purpose? Why do we all pay more money for our houses than we have to if we lived somewhere else? And so, that is where high paying jobs are. That's where most employers are. It's where the companies like to be close to each other. It creates innovation hubs. It's easier for governments to deliver public services, which is important. It's generally proximity to high quality education, high quality healthcare, high quality culture, probably near your family and community and these sorts of things. And indeed, we can see some signs of revival already. You can see condo markets starting to move again, for instance. And so bottom line is, I'm not sure the city story is going to be quite as different as some might imagine. And then a quick word on politics, U.S. politics. Maybe should be Canadian, given that we could well have a Canadian election, it seems like, in the next few months. But and there will be a budget next month. But the U.S. story has been quite significant. So a new administration, it's quite different than the old one, as I'm sure you're aware. We think it's a net positive economically. We weigh the good and the bad economically, and more positives than negatives. Even the stock market seems to judge it as being positive, though the prospect of corporate tax hikes isn't exactly welcome to that particular contingent. We think Biden is bond yield positive, as he has been. We think he's US dollar negative, as he has been. And there may be some further room to each of those forces, though we think other factors could dominate in the bond market. And so let me conclude here, having blown through my promised time allocation, and we can hopefully do some questions in a moment. Let me not speak to all of this, since I'm sure you're all a little shell-shocked from all of this information. Let me just say, top left, I would really say that this has been the biggest economic drop probably in our lifetimes, unless we have some really, really old people on the call. The recovery, though, has exceeded expectations at every turn. The second wave wasn't as bad as feared economically. Human life perspective is a different story, I'll certainly admit. We think that 2021 could be pretty good. Don't forget about structural forces. And so I would say, even before the pandemic, demographics were and are a dominant trend. High debt levels were an issue. Now they're even more of an issue. China's ascension, becoming a multipolar world rather than a hegemonic US-led world. Populism still swirling to some extent, if a bit less profoundly, in our neighbors to the south. We do think it's a structurally slow growth environment still. So we're going to have this happy 2021, probably pretty good growth in 2022. There's still reason to think beneath the surface that we're in a fairly slow growth environment. So that's important, I think. Certainly there are risks to everything that I've said. I've been wrong many times before, and I will be again. Key negative ones revolve around the variant, would revolve around bad vaccine outcomes or slower delivery, would revolve around higher inflation. But there are positives. The vaccines could prove better than expected. And indeed, I would say broadly they have over the last 4 or so months. The recovery could keep outpacing expectations. And again, that has been the dominant theme. We could get more US fiscal stimulus. And indeed, recently we did get that more stimulus, but there could even be a $2 trillion infrastructure package coming as well. So I would say fairly balanced risks, as much as there are ways this could go wrong and ways this could go right. And for those of you who care about the market side of things, and so usually I'm speaking to investment clients, this is what they care most about. They're a bit grumpy. I left, the subject of markets to the bottom left corner of the last page. But nevertheless, a couple thoughts. I would say, it's impressive the extent to which risk assets like stocks have performed through a pandemic, through the worst recession in our lifetimes. It's, I would say, uncharacteristic of how stock markets usually perform during recessions, but not necessarily irrational. If you do the math and say, well, what would happen to the stock market's value, or what should happen in terms of the future stream of earnings if you lose a year's worth of earnings altogether, which is more or less what happened in 2020, you would argue the stock market should be 3 or 5% lower than it was. And really, we got a bigger move than that, and we reclaimed it fairly quickly. And there's this extra twist, which is that in a very low interest rate environment, stock valuations can be justified at quite a high level. And that's been a thought of ours for quite some time, and makes us maybe surprisingly comfortable with current stock valuations, even though they're historically higher than what would be considered normal. We think yields, in fact, yields have now edged higher, I suppose, but we think structurally and cyclically they should still be fairly low. We think stock market can probably beat the bond market still over the coming year. We believe stocks will beat bonds in general over the long run as well. And maybe I'll jump to the currency side and just say we still think the US dollar is in a secular bear market. We think the US dollar can go down somewhat further, and that means the Canadian dollar going up at least a little bit further as well over the next couple of years. Okay, having stolen all the time, I do apologize. Let me stop sharing my screen and I think invite Carrie back. And I believe we're going to try a Q&A. Is that right?
Yeah, Emily back with you.
Oh, Emily, pardon me, Emily.
Yeah,
Thank you.
no, that's totally all right. So Eric, wonderful presentation. I can't believe how much you packed in within that presentation. So I'm sure we're going to be digesting some of that, although I've already got quite a few questions. So I'm just going to jump right in. One, this is a really good question because Greater Victoria, you probably have heard, is a tourism friendly and tourism dependent town, and so the border closure has been a particular consequence to our area. And so this question is really about what do you see the travel restrictions? When do you see those softening? Could you see them softening earlier? And what do you see for the summer, the economy this summer?
Right. Okay. No, great questions. And so, as you will learn, once I start going off script, my knowledge fades. It's mile wide, inch deep. So I'm sure I don't have thoroughly satisfying answers here, particularly for someone who's probably in that industry and thinking very hard about this as well. And here I am in Toronto too, not really feeling the pulse of the Vancouver Island situation. But I guess I'll say a few things. I do think ultimately personal travel will fully rebound. That is one of the sectors I'm quite confident we will not see depressed for years and years and years. So there's kind of a general comment that maybe is of some use. In terms of when does that start rebounding? Well, I think within a Canadian context, as vaccinations roll out, people are going to feel increasingly free to travel, and we should expect significant reopenings happening. I'm sure the goal will be to do that in no later than late spring to capture that tourism season. And so I think there's a very real chance that we see quite a lot of domestic tourism at a minimum. I think the X factor, as you mentioned, is the extent to which the U.S. border opens, and so that would be, I gather, a big client base. And so, it feels to me like Canada has been generally the party that has been more firm on closing the border, and the U.S. now is greatly ahead from a vaccination perspective, and you can argue, at least for adults, probably almost all American adults who want to be are going to be vaccinated probably by the end of May, even at this point in time. And so I would say I think we will see the U.S.-Canadian border significantly open before summer. That's my thinking. It's tricky third wave that might be an April and early May thing, and so on. But and this is being overly precise and false precision, but I would say it wouldn't surprise me if towards the end of May we saw a lot of normalization happening, both because of Canadian vaccine progress and U.S. progress. And just the key would be if you've got a fairly similar environment in the two countries, that's where you lose the argument for remaining closed. So I'm hopeful that's what happens. I was talking to a prominent hotelier in London, England, a while ago, and he was making the comment, but like, families have children, like what's happening? The children can't get vaccinated. How does that all play out? And so this is one of the items I'm struggling a little bit through. I do think children will be vaccinated. In fact, children get most vaccines when you think about it. And so there's no fundamental reason they can't. And it sounds as though they may start being vaccinated by the fall. The question is whether, as much as you see all these vaccine passports and Iceland is allowing tourists with vaccines now, and China is creating an international travel program if people have been vaccinated, and the EU is going to open up fairly quickly, I think, within its own set of countries for people who have been vaccinated. So fully expect, whether it's a vaccine passport or just different vaccine rules, like in the US, you can be inside a room with someone else without a mask if you have a vaccine now, I believe. And so I do think we'll see that the children are an X factor. I think in the end, to the extent that they may spread it slightly less and they don't have adverse consequences and you can still get close to herd immunity without them, my suspicion is it will be possible to do these things even without children being inoculated. But that's, I guess, is one thing to keep an eye on.
Okay, great. Well, we're having our next month's talk is going to be on the U.S. border, so that'll
Oh
be
boy. Okay. Well,
we'll
that
be
person's the expert. Don't listen to me.
no, well, it's a very hopeful note, so I appreciate that. Another question here, really related again to BC's economy. So if it's beyond your expertise or your willingness to speculate, which we love, by the way, go ahead and speculate. Please feel free to tell us. But BC, of course, it has done better than a lot of the other provinces. This question is really about are there structural reasons for that, or do you think it's our sector mix? Construction. One guest here suggests that construction hasn't halted, and that's been a big factor. The question though really is around was it due to the reaction with the lockdown measures and how sort of relatively unrestricted these lockdown were, or to do with the sort of sectoral breakdown?
Yeah, no, it's a good question. And so I must confess, I've got a few answers, but my memory grows a little hazy just in the sense that in the early going, we were all over trying to sort out the provincial differences. Literally there were worries like provinces would default on their debt and things. We had provincial bond managers, this not nearly happened, but nevertheless, we were going into detail, and we haven't done it as much recently. So when I think back, I guess there are a number of considerations. Some relates to the average age of a province. And so I know Vancouver Islands are famously, and Victoria famously, a little bit older, but in general, it's not the oldest part of the country. A lot of immigrants have come there and so on. And so that's a little bit helpful. But I think a number of things. It seems to me there was a more scientific approach perhaps to lockdowns and this sort of thing. So you were in fairly good hands. I'm sure people are grumbling right now. Nevertheless, fairly good hands from that perspective. And so I think that may have factored in. The fact that the weather doesn't get as cold in winters and things probably helps as well. We think it's a bit of an X factor, and I could rebut my own argument probably if I needed to, but nevertheless, I think that might factor in. And then sector mix, certainly is a very high skilled, high knowledge economy. And so a lot of people could work from home, disproportionately, in fact, relative to some. And then construction, of course, I'm seeing someone mentioning construction was never halted, which certainly would have been a big consideration. And other provinces learned that lesson a little bit later. But, construction is disproportionately an outdoor activity and allows a bit more spacing. And so, versus say manufacturing, which is, often indoors and a source of considerable spread, perhaps in places like Ontario. So I'm grasping a little bit at straws here. And I should say one of the enormous frustrations through all of this has been, we think we're smart, we have all this data, and boy, I would challenge anybody to build like a model that actually precisely explains why country X or region X did well and country X or Y did poorly. You can kind of get the broad strokes, but it's we're looking recently and, Spain's numbers look incredible and France's numbers look awful, right? Like, why is that difference? It's not that clear. So I would say that those would be my guesses. I should say places that have done better though seem to have done enduringly better. So Japan, despite being old, close to China, not having locked down that much, and so on, they've done notably better than a lot of places. And so there may be some sort of cultural factors that I don't fully appreciate, but perhaps people are social distancing a little bit better as well.
Okay, awesome. Thank you. Another very good question. This one from Michael Lane. Eric, can you talk a little bit about the discrepancy between the initial perceived decline of 35% versus the actual 15% that you quoted?
Right. Sure. I'd be happy to. That's right. And so I will admit, when I think back to last March and April, I was initially thinking we had scenarios. It was like the economy might shrink 5% or 10 or 30 or 50, and we just didn't know. And we kind of narrowed down as data came out. Initially, I thought it was going to be steeper than it was. And so in significant part because we were looking at real-time data that was making that argument. I think a big part of it is what kind of real-time data we're able to get our hands on. And so, for instance, we have open table restaurant reservations, and we have like daily air flights globally and for countries and things like that, which of course collapsed. And conversely, and we did have other things. We had some daily, I would go to websites. It was quite a do-it-yourself affair there for quite a while. But nevertheless, we certainly did have little samples across the economy. But for instance, we didn't have a good gauge for like, what's the public sector up to? And, they had their own challenges, but ultimately that was a sector that could keep on clicking along fairly well. economists struggle with the financial sector, my own employers, enormously. What is the productivity level? What is the, like revenue isn't really a concept even necessarily in banks, in the sense that you're not really selling for X and buying for Y and earning a difference. It's just kind of a different business altogether. And so, there weren't really any real-time financial sector metrics. So the sectors that broadly did better, we didn't have real-time agricultural metrics either. The sectors that did better were probably underweighted, if that makes sense. So I think that mostly explains it. I guess that's probably it.
Okay, thank you. Another one here from Troy Ziegler. There's talk that the federal government has significantly overreacted financially to the pandemic. Do you believe that that's true or false? And if so, what are the consequences?
Yeah. So, certainly you're right in your assertion that Canada has done a lot and indeed did more than the average country. So in 2020, Canada ultimately ran a deficit of 20% of GDP. The US was 15 or 16%. A lot of European countries were sort of 12 or 13%. So Canada did go big, and everybody was going big, but Canada went extra big. And so I'm kind of torn on that. Like, certainly a lot of support was necessary and everyone did a lot, but was this extra amount from Canada necessary? And so it's hard for me to say. I mean, Canada did ultimately, see its unemployment rate go up less than Europe. I should say we can't even see European unemployment rates because they're furloughing workers on payroll often. But from what we can tell, the Canadian economy, I should say, wasn't hurt as badly as Europe was. And so I think there was some payoff from that. And it's tempting to compare to the U.S. and say, well, the U.S. economy did even better. But take a look at their fatality figures as well. They just tolerated more death. And so that's another strategy you could pursue. And it's a tricky math because you do ultimately have to put a value on a human life to decide just how much support is needed or how much lockdown is needed. But in the end, I would say Canada did get something for the extra spending that it did. It wasn't perfectly targeted. It wasn't anywhere, but we're all a bit grumpy that probably nobody should have made more money not working than they did working, as an example. And there were some groups that ultimately fared better, received money that maybe didn't fully need it. But in the grand scheme, I would say maybe there were a couple percentage points of GDP more than was strictly needed. I think that's a fair critique, but equally, this could have been a Great Depression kind of situation if we hadn't done that. And the fact that mortgage delinquencies are low, and of course that was another big program deferring debt for companies and households, and the fact that bankruptcies are low and this sort of thing suggests that actually they did a pretty good job. So I'm reasonably content, as much as I could have done with a little bit less money. And I should say, as much as the US did less in 2020, they're going completely bonkers in 2021. And so I think at the end of this year, if we look back and say who distributed their money most effectively, I think Canada probably comes out on top, because the US is now spending way more than they need. Like, their unemployment rate's already down to 6%, and they're going to put another $2 trillion out there, and perhaps even another package after that. So I think by that metric, Canada has been cautious, but there was a bit too much spent.
Okay, well, that's a great segue to our last question, Eric. And the question is from Basma. And she asks here, she's commenting on the different green recovery sort of stimulus spending that's occurring. And how do you think this focus on the green economy is going to affect the growth forecast for Canada? So also, and I think an important part that segues from your last question is, are we well positioned when you look, or is there a risk of falling behind when you look at some of the investments that are the green stimulus spending that's occurring or slated to occur in Europe and America?
Right. I think Canada's, well, gosh, I mean, we're fairly well positioned from a policy perspective. And so, and this is, again, I fully expect screaming at the monitor somewhere, but Canada has a carbon tax that is working towards achieving the kind of carbon goals that Canada has as part of a global climate plan. And so if you buy into all of that, I would say Canada's strategy is not bad. The way fiscal stimulus usually works after a recession is kind of twofold. You first get the unemployment is high helping hand. So that's mostly what we've seen. Usually it's later you then get, and we should probably do some infrastructure and things like this to build for the future. And so I would say, in the specific context of the last year or two, Canada hasn't fully made that pivot. And I would say most countries are just starting to think in that direction. The US now talking about an infrastructure plan, and inevitably infrastructure including a fair bit of green. And so I would say Canada is doing reasonably well from that perspective, I think. The twist, of course, though, is Canada's a big oil producing country. And so we've got a part of the country that's very exposed to fossil fuels, and that's quite a challenge. And the reality is fossil fuel demand is going to rise for the next 10 or 15 years globally based on the credible forecasts I see. So this is not a market that is in active decline right now. Nevertheless, it's not likely to be as much of a growth sector as it once was. And you probably don't want to be making 50-year investments into the sector because it could well be that demand is significantly lower in several decades' time. And so it feels to me like the capital allocation we're seeing at the private sector level is mostly reflecting that. And one of the things that we spend a lot of time on these days is ESG, the environmental, social governance, that trio of concepts. And I mean, selfishly, we find it to be a good way to make money for our clients. You can actually invest wisely by thinking about those things. But increasingly, companies are very much paying attention to that as well. And so I do think Canada is making reasonable progress, and probably better than most, but with this additional challenge to start with, which is we have this, you might call a legacy industry that needs to itself manage this.
Yeah, well, I think we can all rest assured it will be an interesting election season ahead, because this is certainly becoming, major topic, that supersedes left or right. So
Yes.
Thank you for that. Thank you, Eric, for such a fascinating and very timely presentation. I also want to thank RBC for making it possible for Eric to join us today. RBC is a member of SIPP. So I'd like to thank you all and all of the SIPP members and your guests. You are the economy builders, and we are happy to be able to provide this ongoing series to give you the top of the line insights into our national and regional economy. So please sign up for our email or check your social media for news about our next Leading Economist session. And thank you all for being here. Enjoy the rest of your days.